Before I show you the differences between an actively managed mutual fund and a passively managed mutual fund, there are three key questions you need to consider to find the right investments for you. When do you need to gain access to the money you're investing, and how much risk you're willing to take? If you need the money within the next 3 years, then you might want to consider investing in something that is safer or risk averse. Can you take some losses in the short term and hold them for the long term? And when you look into the mutual funds, you need to look into the long term track record, like how it's performed in the past 5 years or maybe even 10 years. I chose to invest in index funds because they're cheap and they have a long term track record and all the historical returns. When you research any types of investments, you need to first know or understand the differences between an actively managed mutual fund and a passively managed fund, or also known as an index fund. And keep in mind that an index fund doesn't necessarily mean that it's a mutual fund, but it could be either a mutual fund or an ETF. That's probably one of the most common misconceptions out there. So it's actually called an actively managed mutual fund or actively managed ETF. If it's an index fund, it could be an index mutual fund or an index ETF. That makes sense so far, right? So an actively managed mutual fund or ETF means that the fund managers are actively trying to beat the benchmark like the S&P 500, Dow Jones, Nasdaq, and many others because they're constantly trying to beat the overall market. The turnover ratio could be a lot higher, which means that they're going to buy and sell stocks more frequently in the mutual fund. And I want you to think of it this way. You are the person in charge of this actively managed mutual fund with a basket of stocks, and you look at the S&P 500 and it's performing 10% so far this year. Your job is to beat that 10% by buying and selling stocks inside the mutual fund and get that 12, 15, or maybe even 20% return. If you don't, then people will sell out your mutual fund and go somewhere else, right? That's how an active fund typically works. And the upside of investing in an actively managed mutual fund or ETF is that your money could earn a higher return than the benchmark. And if you look at some of the active funds in the past, they have done some incredible returns against the benchmark, which makes them very attractive to some investors who don't want to settle with an index fund. Do they always beat index funds? Not always, because these fund managers are constantly trying to beat the market. The turnover ratio could be much higher than an index fund. So you could be paying more capital gains if your investment is not in a 401k, Roth IRA, HSA, or other tax-free or tax-deferred accounts. So it's much more tax efficient if you invest active funds in a retirement account. And the big downside of investing in a active fund is that they do charge you a much higher management fee, regardless of how the mutual fund or ETF performs for the year. For example, a lot of people like to invest in what's called an ESG mutual funds, okay? And which stands for environmental, social, and governance. So they only invest in companies that have higher standards in environmental protection, labor standards, and ethical business practices. And some of these active ESG funds have a much higher expense ratio. So if the ESG mutual fund makes a, let's say, 7% return, and the expense ratio is at 0.75%, then your net return is really 6.25% before adjusted for inflation, right? And you have to be extremely careful or cautious about the management fees because they will eat into your profit if you're not being careful. And keep in mind that a mutual fund's expense ratio, like this one, is charged on the total value of the account and not the gains. So you, as an investor, would still have to pay the expense ratio if the mutual fund loses value. If the mutual fund makes a 5% loss for the year, then you're looking at a total loss of 5.75% using the same example of 0.75% in expense ratio. That makes sense so far, right? And don't get me wrong, I have nothing against active funds. I would just prefer to invest in index funds that are passively managed with a low fee. And Warren Buffett even said in the 2020 shareholders meeting that the best thing for people to do is to own the S&P 500 index fund. And when you invest in an index mutual fund or an index ETF, your money gets exposure to the entire US market and benefits from his historical upward trajectory for a very low fee. Warren Buffett said he owns two S&P 500 index funds. One of them is VOO, and the other one is SPY or SPY. VOO is the Vanguard S&P 500 Index ETF that charges 0.03% in expense ratio. That's $3 for every $10,000 you own in this S&P 500 ETF. With an active fund that charges you 0.75%, that's $75 for every $10,000 you invest. That's a huge difference, right? If you're just starting to invest now, the expense ratio between 0.03% and 0.1% might not make a huge difference. But once your portfolio reaches 5 figures, 6 figures, or maybe even 7 figures, the expense ratio is the one thing you need to pay special attention to. So the definition of an index fund is very simple. It is passively managed. So it just tries to match the performance of a specific market benchmark as closely as possible. It doesn't try to beat the market or lose to the benchmark. It just rides with the market. Okay. And they have a lower turnover rate than an active fund because it just matches the performance of the market benchmark. If the S&P 500 swaps out one of their stocks, because they have 500 stocks, right? Then the index fund would just do the same thing, and which makes index funds very tax efficient compared to active funds. I have a variety of index funds inside my taxable brokerage account, and most of the time, the only tax I would have to pay is the dividend reinvestments. That's right, S&P 500 ETF or any index fund actually pays dividends every quarter or every year. Sometimes capital gains do happen, but they don't happen very often. I don't get taxed for the capital growth, but I will have to pay capital gains tax on the qualified dividends every year. So keep that in mind about the index funds. And what makes them attractive is the low fee. The average expense ratio for the index funds I'm investing in is about 0.06%, and that is pretty much average across the board. So when it comes to investing, you need to think about the cost and tax efficiency. I have met plenty of people who just don't know what they're doing and end up paying more fees and taxes, which eat into their profit, right? You can schedule your 60-minute session with me by visiting firestation.com/coaching if you want to chat more about that. VOO, for example, like the one Warren Buffett is investing in, is the S&P 500 ETF, index ETF managed by Vanguard. It follows the S&P 500 benchmark. So if the S&P 500 goes up, then this ETF will also go up. If the S&P 500 goes down, then this ETF will also go down. It's not trying to beat the market. It just follows what the market does. And the other ETFs that you can check out, maybe QQQ, Invesco QQQ Trust ETF. That is another example of an index ETF that follows the performance of the largest non-financial companies in the NASDAQ 100 index. This ETF focuses on technology and growth companies. So it offers a high risk, high reward scenario. And another index fund that has higher volatility is the Russell 2000 index fund, which tracks 2,000 small cap companies in the US. If you want something even more diversified, you can look into the US total stock market index fund that tracks 3,000 or 4,000 US stocks in one single mutual fund or ETF. Fidelity has its own version, Schwab has its own version, and Vanguard has VTSAX or VTSAX for the index mutual fund and VTI for the index ETF. My retirement investments for the past 10 years have been the S&P 500, which is growth, and put a certain percentage in aggressive growth and another small percentage of my portfolio in a very few individual stocks that I believe in long-term growth. This is what worked for me. What will work for you will not be the same as what's been working for me, okay? So when you're in search of the right index fund to invest in your 401k, Roth IRA, or taxable investment, you need to first understand which benchmark these index funds will track. If you look at the S&P 500 index funds or benchmark, you need to understand how well it has performed in the past 5, 10, or even as far back as 20 years, or maybe 30 years. Could the S&P 500 collapse again like it did in 2008 and 2009 by over 50%? Sure it would, or it could, right? But it has a track record of a long-term recovery and growth that really attracts investors. And this is not in any form of personalized financial advice. You just need to understand the risks and exposure of investing in any types of index funds. The S&P 500 tracks the 500 largest US companies like Apple, Microsoft, Tesla, Google, Nvidia, and many others. Does that index fund grow every year? No. We will face some years with negative losses, But if you're afraid of the S&P 500 collapsing to zero, then we have a bigger problem to worry about. Now, I'm not worried about the S&P 500 collapsing because I believe in the US economy more than I believe in any other country. Is an index fund always going to give you a positive return every year, though? Of course not. Because before you invest, you need to understand what you're investing in. That is the most important thing. Otherwise, it's just gambling. You need to be very aware of where your money is and how each index fund will grow based on macroeconomic conditions and company earnings, right? But remember that the fastest way to grow your money is by increasing your savings rate. Saving 10% of your income and making a 10% return is not going to be as good as saving 15% of your income and making an 8% return, right? Don't just go over the expense ratio for every index fund, but you also need to be aware of additional management expenses if you have a 401k, 403b, or 457 TSP, or other employer-sponsored retirement account. Some 401k can be expensive, so you need to keep in mind how much of your profit will go to the broker, right? Just remember that the key to your success in achieving financial independence will require you to focus on long-term growth and not short-term noises. Your first $100,000 will be the hardest to achieve, but it'll be a lot quicker to get you to $1 million due to compounding interest and dividend reinvesting every year. And I got to my first $1 million by buying and holding. When the market was down, I bought more. When the market was up, I continued to buy because I was focusing on my long-term time horizon. Index funds are the cheapest way to invest, and I just simply ride with the market. You can get my free compound interest calculator, 401k calculator, and other retirement calculators by visiting 568.com/resources. And this has been another beast of a video, and I hope you got a lot out of it.